Hello, John. Thank you so much for joining us today. We're in very interesting times. How are Aldermore finding the current climate?
Thanks for the question, David. And so the way the bank's finding the current climate, it's October 2023. Interest rates have moved a lot over the past year. And there's been a fair bit of impact on valuations of certain asset classes, which we're starting to see a little bit of that come through now. We had, and also that rising interest rate costs clearly has an impact on borrowers in terms of being able to make sure they've got the cash to meet that. I have spoken to you before, I think, about this, where in March 20, I set what was COVID resilient, a COVID resilient appetite. And more recently, we've set what I would say is a recession resilient appetite. So the assets that we've really focused on looking to fund have been in those areas where we think there's really good demand and good demand throughout the cycle. So those have been assets such as residential, people need to live somewhere, student accommodation, where there's a really good supply-demand metric, and therefore there is a lack of supply, fairly inelastic supply, but really strong demand. And so that's quite a good area to look at as well. Healthcare, elderly care, again, that's the demand isn't driven by recession, it's driven by demographics. And the demographics are that supply-demand metric is in the right balance.
Well, that's quite a wide area of opportunities. What does good actually look like?
So a good opportunity looks like we're always backing good operators, proven operators. Our strapline as a bank is to back people in life and business to go for it. And it really is a great example of how we back people. So you back businesses, you back people who come to you, they've got businesses, they've got proven experience, they've got a clear strategy about how they're going to carry on that business. And so what we're looking for is people that have a really clear vision, clear business plan, some proven experience, and that we're there to back them for the long term. One of the other things we talk about is relationships that last, and I think that's the point, is that you're there to be a long-term partner with someone who is clear in the markets they want to play in.
And costs across the board are continuing to increase. What impact is the rising rent environment having on the real estate industry?
So rents are rising, David. There's no doubt about that. I've said quite a few times in recent press articles around the fact that base rate has been set since 1694 by the Bank of England, and the long-term average is somewhere between 5 and 6%. So where we are now is kind of in that long-term average. Feels high compared to the last 13 years, but over the timeline, take a step back, it's not. What you also know is that long-term property is seen as a good hedge for inflation. So as interest rates rise and inflation rises, so do rents. And the timing of rent rises is driven by the trigger in terms of where's the review patterns. So what you look at is clearly on residential, there are shorter review time periods. Therefore, that is front page news. You start seeing that now, and that does have an impact in terms of them starting to come up. You also see that in student, which we mentioned earlier on as a sector. They're reviewed annually. So again, you can start seeing the rise of those rents come through on an annual basis. Other commercial assets, those rises will depend on the review patterns of the leases that are in place. So that movement, that very rapid movement in interest rates, and the rapid movement in terms of inflation, there's a bit of a time lag just now for those rents to play through. I think I've always said this and continue to preach this, is that, good quality properties in the right locations will drive good demand. And it is that classic inelastic supply, strong demand. You'll see growth in rental on the back of that. So in terms of some of the commercial assets, we've been really comfortable with industrial and logistics. There was an impact on values in those sectors because of interest rates and the yields coming off. But there's been rental growth because the pattern of UK PLC online sales has been growing versus people going into retail areas. Retail, we've really driven towards more essential retail because we have that concern that discretionary retail will be impacted as people's real incomes start to diminish. There'll be a curtailment of the ability to spend on discretionary items, and so certainly some businesses will be more affected by that. And offices is one. When COVID came, we were really cautious about office. I view more as now that there are certain offices, good quality. I think it comes back to your question about what do you look at. Good quality offices in good locations will have good demand because users' demand for spaces start to come to maybe smaller floor plates, better quality to drive good collaboration for their staff. And more employers are looking to get their employees back to the office. So, I don't think there's the death of the office by any stretch of the imagination, but what offices will look like going forward will be different to where they've been in the past.
And John, you refer to ESG. Why should investors and developers be looking at ESG early on in their journey?
So I think ESG is one of those things as a focus for investors and developers is that for users or buyers of assets, it's the efficiency of the properties longer term that is going to drive some differential between where values go. Now, there are changes to EPC legislation, as we know, and a drive for better levels of EPCs and BREEAM. But I suppose the best example I can use is we fund a developer in this country, and they're really focused on community living and in terms of sustainable development and a community life. And they actually have solar panels that collect excess power that goes for the benefit of the community, not to the grid. And what that means is that those occupants, those people who occupy, they have technology that tells them we've got loads of power, so put your washing machines on or whatever else. So it reduces their energy costs because they're not having to pay into the grid. And I think it's a good example of the efficient use of property going forward is going to be a big driver and a differential for pricing and demand. And clearly with EPC legislation, those poorer quality ones will ultimately become unviable in their current state and would need to have development, investment, or possibly even a change of planning use to get to an asset class that can drive demand.
John, thank you so much. Hugely interesting and informative as usual. Thank you.
Thank you.